Bloomberg News.
Dubai World is speaking with banks to restructure $26 billion worth of debt, half of the amount that we spoke about yesterday. Joining us on the phone right now with his reaction to this headline and others is Marc Faber. He is a noted investor and also the editor of the Gloom, Boom, and Doom report. He's with us by telephone from Prague. Marc correctly predicted the stock market crash of 1987 and called the market bottom in March of this year. Marc, always glad to speak with you. Thanks so much for joining us.
My pleasure.
Should we take a little, I don't know, sign of optimism that the amount of debt we are speaking about today in regards to Dubai is half of what we thought it was yesterday?
Well, I'm not sure it's half, but in the context of all the defaults that will still happen in the world, it's not a big thing. But it's a reminder that also governments can default, so companies that are perceived to be government guaranteed can default. And so I think it's kind of a warning signal whereby the markets probably don't take it very seriously because they see that each time there is a problem, the central banks come in and print more money. And if there is further weakness in the economy, obviously in the U.S. we'll have more stimulus packages.
Marc, you just talked about all the defaults that will happen. Are you anticipating any other sovereign defaults or quasi-defaults, say, in the next 6 months to a year?
Next 6 months to a year, maybe not, because they can print money. Or in the case of Europe, where you have weak credits like Greece, they may first opt to leave the Eurozone. But eventually, I suppose that a lot of governments will be bust, including the U.S.
So you mentioned Greece. Marc, what about Latvia, Ireland? These were just some of the countries that we were finding yesterday in the past 48 hours where credit default swaps seem to be implying that there's a lot of market fear in regards to these countries.
I think initially they will be bailed out, but as I said, historically, occasionally there were huge sovereign defaults and government-sponsored enterprises defaults. So what we've seen is just the tip of the iceberg, and I just maintain that we had a financial crisis in 2008. We then had stimulus packages and quantitative easing, but nothing has been resolved. It's just being postponed. And the ultimate crisis will not just bankrupt the banking system and the financial sector as has happened in 2008, but it will bankrupt governments.
Marc, you just said that you expect the U.S. to go bust, and I know you've held this view about U.S. monetary policy and fiscal policy for a while, but let's talk about it in the context of the Treasury market. The 10-year Treasury is yielding only 3.325%, and the 2-year is at 0.66%. Should investors, in light of your view, be running for the hills from the Treasury market?
Well, I'm not sure they'll have to do it today, but I think the upside potential for U.S. government bonds after a 20 years bull market, which began in 81 when yields were still at 15.84%, is extremely limited. And I think government bonds in the U.S. are a poor investment for two reasons. A, the U.S. dollar is structurally a weak currency, so the 3.32% you're earning is likely to be lost over time in currency depreciation. And secondly, if the deflationists are right and we have deflation, much more money will be printed and there will be more stimulus packages. More stimulus packages means the government debt goes up. The government debt goes up. The credit worthiness of the U.S. government goes down, and so eventually U.S. government bonds will have a much higher yield than, say, corporate bonds.
Well, you've long held, Marc, as Eric said, that the U.S. is really not the place to put the money. Where is the best place? I mean, we just had that strong Chinese PMI. Does that increase the argument for China more than ever?
Well, I'm not a great believer in Chinese economic statistics. I mean, they've learned one thing from the U.S. is how to massage and doctor economic statistics. So I don't take that on face value. But I have to say, if I look at the world, then we have essentially the most advanced economies of Western Europe, the US, and Japan. And then we have emerging economies around the world. They have 80% of the world's population. And combined, their economies today are already larger than the economies of Western Europe, the US, and Japan together. So my view would be that an investor should have at least 50% of his money in emerging economies in the long run. I'm not saying he has to do it tomorrow morning.
All right. We have to leave it there, but we thank you for our time. That was Marc Faber.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP 2009.